Hi, I'm Jennifer Thompson, and I'd like to talk a little bit on the fundamentals of investing. So in the world of investing, there are really basically four asset classes. And all investments really fall under one of those four asset classes. The first asset class is what we call cash or cash equivalents. Cash and cash equivalents are investments that are really meant for short-term goals, like an emergency fund, or maybe a down payment on a house. It's really where you park some money, and they're really meant for goals that are not more than 2 years or 3 years at the most. Because cash and cash equivalents do not give you a high rate of return, but that's because they're not invested in the stock market. They're really short-term. They're short-term fixed income, and they could be like a bank account, a savings account, or a short-term term deposit. And so they're not invested in the stock market, which means that they have no propensity for fluctuating at all. They're really very safe. So you want to put some of your assets in short-term vehicles such as cash and cash equivalents. The second asset class is known as fixed income, and that's comprised mainly of longer-term term deposits and also the bond market. Bonds are fixed income. So the asset class called fixed income produces an interest, gives you an interest, whether it's monthly, quarterly, or annually. The return comes in the form of an interest. Fixed income can be a little more risky than the first asset class, which is cash and cash equivalents. Fixed income, especially bonds, have the propensity to fluctuate in value unless you hold the bond to maturity. So that's the second asset class, and their propensity for volatility is a little higher than cash and cash equivalents by and large, but they're not as risky or as volatile as the third asset class, which is called equities. Equities is really ownership. So equities are stocks and shares in a company. Equities also, real estate is also a form of equity. So equity has a greater propensity for fluctuating than the first two. So we consider it a little more risky. And if you're investing in equities, you want to have a longer term time horizon. Cash and cash equivalents are for needs for less than 2 years, and then the bond market is really for between 3 to 5 or 6 years, and equities is longer for needs or goals that are targeted as long-term goals. Retirement is a good example of a long-term goal. Or maybe you've got you want to build a house and you're not wanting to do it before 10 years. Anything that's longer term, a longer term goal, you want to be invested in some equities because it has the greatest potential for return compared to the first two asset classes. So the first one was cash and cash equivalents, second is fixed income, third is equities, and the fourth asset class is what we call alternative investments. And they comprise of things like Bitcoin, silver and gold, heavy metals, and also art, derivatives. Of all the four asset classes, the fourth one is considered the most risky, with the greatest potential for fluctuations in the market, or the greatest potential for variations in value. So those are the four asset classes. The first is cash and cash equivalents, second is fixed income, the third is equities, and the fourth are alternative investments. Now, the amount of money you put in each, or the proportion at which you put your investments, is dependent on three things, because that's the question people often ask. What proportion should I put my assets or my money into? You want to have your money spread on all four asset classes, because that would give you that would give you a more balanced portfolio. Now, the proportion at which you put your money into these is dependent on three things. The first one, what is the money for? Because if you have short-term goals, you want to put more money in the short-term vehicles. Long-term goals, of course, longer-term vehicles. So first thing, what's the money for? Second is, what is your tolerance for risk? Now, there's some folks who cannot sleep at all if there's even 5% of their investments that have the propensity to fluctuate in value. They're missing out on the potential for returns, but for some people, they just cannot take it if the value of their money changes, the principal changes in value from one day to the next. So if you are extremely conservative, you want to have as much money as possible in cash and cash equivalents or fixed income. And finally, the third thing that you need to consider is, what are your other sources of income? Even if you're the most you're someone who's really willing to take a lot of risk, but you don't have a steady income, it is not wise to put all your money in something that, while has the greatest potential for return, also has the greatest potential for loss in the short term. So you don't want to put something in that has a lot of fluctuations if you don't have any other source of income but your investments. So that's some of the basics of investing, and I will share with you more. Please like, subscribe, or comment on my videos. I'm Jennifer Thompson, and have a great day.